One person invested for 10 years then stopped completely. The other invested for 30 years without missing a single month. 40 years later, the one who stopped early had more money. By over $250,000. That result breaks something in your brain the first time you see it. Because everything you've been told about money says the person who tried harder should win. They don't. And understanding exactly why is the difference between building real wealth and spending 40 years doing the right things in the wrong order. Today I'm going to show you 5 laws that govern how money actually behaves in Australia. Not opinions. Not motivational advice. Mathematical laws, the kind that work the same way every time, whether you believe in them or not. By the end of this video, you will never look at your pay, your super, or your investments the same way again. Let's start with the result that broke your intuition. The early investor put in $500 a month for exactly 10 years. Total contributed $60,000. Then stopped. Never added another cent. The late investor waited 10 years, then invested $500 a month consistently for 30 years. Total contributed $180,000. 3 times as much money, 3 times as long. Same ASX returns. Same everything. And the person who put in a third of the money, and then quit, ended up ahead. How? Here's the part almost nobody explains properly. Your brain thinks in straight lines. Double the time, double the result. Double the money, double the outcome. That's how a staircase works. Compounding doesn't build a staircase. It builds a ski jump. For the first decade, it does almost nothing visible. It feels like pushing a boulder uphill that won't move. This is the exact stretch where most Australians give up, switch strategies, or decide investing doesn't work for them. But here's what's actually happening in those quiet early years. The base is building. And once the base is large enough, the growth doesn't add anymore. It multiplies. Watch the same investor who never stopped. $500 a month, 8% per year across a diversified ASX portfolio over 40 years. After the first 10 years, the balance sits around $91,000. Modest. Forgettable. You'd be forgiven for thinking nothing was working. Now look at the final 10 years. Years 30 to 40. In that single decade, the portfolio grows by over $1 million. More than 10 times what the entire first decade produced. Same $500 a month. No change in strategy. No change in returns. The only new ingredient is time. The boulder that felt immovable at the start is now rolling downhill on its own momentum. That is the first law. Time compounds harder than money does. Here's the practical tool that makes this real. The rule of 72. Take your expected annual return and divide 72 by it. The result is roughly how many years it takes your money to double. At 8% annual return, a reasonable long-run expectation for a diversified ASX portfolio, 72 divided by 8 gives you 9. Your money doubles approximately every 9 years. Over a 40-year investing career, the same dollar doubles more than 4 times over. Start 10 years late and you don't just lose 10 years of saving. You lose an entire doubling at the end. The largest one. The one that would have mattered most. That missing doubling is worth more than every contribution you made in your 20s combined. It goes further than most people are comfortable accepting. A lower return held longer beats a higher return held briefly. Every single time. $10,000 at 12% per year for 20 years grows to roughly $96,000. The same $10,000 at just 7% per year but held for 40 years grows to almost $150,000. The lower return wins. Not barely. By 50% more. The investor chasing the bigger number lost to the investor who simply refused to leave. So the first question isn't how do I find a better return? It's how do I stay in long enough for the return I already have to do its job? Time is the lever. Almost everything else is noise. Now, time can only compound something. Which raises the question, what exactly are you feeding it? Law number 2. And this one reframes everything. There are 2 completely different kinds of money. Most people have never been told the difference, and not knowing it is the reason high earners go broke. The first kind is cash flow. Your salary. The rent check if you own an investment property. The income from your side hustle. Cash flow pays the mortgage, the groceries, the school fees. It keeps you alive this month. But it doesn't compound. Because you spend it. Cash flow is a river. It flows continuously while you're working. The moment you stop working, the river runs dry. Within weeks, sometimes days. The second kind is equity. Ownership. Shares in a business through your ASX portfolio. A stake in property. The balance growing inside your superannuation. This is money you don't consume. Equity is a reservoir. And it's the only form of money that compounds, because it's the only form you don't drain. Here's the arithmetic that makes this undeniable. $1 of wages, earned and spent across a working lifetime, grows at roughly 0.5% per year above inflation. That's what renting your time produces across 40 years. $1 of ownership, equity in ASX shares, a property, a business, grows at around 7% above inflation per year over the same period. Over 40 years, the dollar of labor becomes approximately $1.20. The dollar of ownership becomes almost $15. Same dollar. The ownership side did 12 times the work. Labor pays you once. Equity pays you while you sleep. This is also why a pay rise doesn't automatically make you wealthier. A raise increases the river. If your lifestyle expands to match, which is what almost always happens, the reservoir never fills. You can climb from $60,000 a year to $200,000 a year across a career and arrive at the end of it just as dependent on next week's paycheck as you were at the start. Bigger river, same empty reservoir. Picture two Australians. One earns $200,000 a year and spends every cent. The other earns $80,000 but holds $1 million in ASX shares and super. Ask how many years each could stop working tomorrow and still cover their costs. The $200,000 earner, 0 years. The income stops, everything stops. The $80,000 earner drawing 4% from their equity, indefinitely. The lower earner, by every measure that actually matters, is the wealthier person. How much equity do you need? There's a clean rule. Multiply your annual spending by 25. That's the reservoir size that generates 4% income to cover you permanently. Spend $60,000 a year and you need $1.5 million in equity. Spend $40,000 and you only need $1 million. Notice what that means. Cutting your spending doesn't just save money. It physically moves the finish line closer. Every dollar you stop spending reduces both what you need and how long it takes to get there. That is the second law. Income keeps you alive. Equity makes you free. Law 3. And this is the one most finance content gets completely wrong. Leverage. Buy a $600,000 investment property in Brisbane. Put down 10%, $60,000 of your own money, and the bank funds the rest. The property rises 10% to $660,000. You didn't make 10%. Your $60,000 became $120,000. You made 100%. 10 times the return from the same price movement. Every finance channel in Australia stops the maths there. I'm not stopping there. Run the exact same property in the opposite direction. It falls 10% to $540,000. The loan doesn't shrink. You still owe the bank every dollar they lent you. Your $60,000 of equity is now zero. A 10% move in the property erased 100% of your money. And that's the polite version. Add stamp duty and purchase costs, and the same 10% fall doesn't just wipe you out. It leaves you owing more than the property is worth. Underwater. On a property that barely moved. The same dynamic plays out in the share market but faster. Borrow to invest using a margin loan. Put in $50,000, borrow another $50,000, buy $100,000 of shares, and you've created 2-to-1 leverage. When the market rises, you look smart. But you agreed to something when you took that loan, and you probably forgot it by the time it mattered. Your position has to stay above a minimum value. The shares don't have to fall far, around 29%, before the lender issues a margin call. They don't ask for your input. They sell your position at the worst possible moment to protect their loan. And they lock in your loss permanently. The exact same market drop that a patient investor with no leverage could simply wait out forces the leveraged investor to sell at the bottom and never recover. This is the whole truth about leverage. And it is the third law. Leverage multiplies everything. Your gains and, in exactly the same proportion, your losses. It is not free money. It is borrowed amplification. And the amplifier runs in both directions simultaneously. Used carefully against an asset you understand deeply and can afford to hold through a bad year, leverage is one of the most powerful tools in finance. Used to reach for something you couldn't otherwise afford, it turns a temporary setback into a permanent one. Law 4. The one that decides whether you survive long enough for the first 3 to ever pay off. Most people treat a loss and a gain as mirror images of the same thing. They aren't even close. Lose 10% and you need to earn 11.1% to get back to where you started. Manageable. Lose 50% and you need 100% just to break even. You have to double what's left. Lose 80% and you need 400%. Lose 90% and you need 900%. The whole doesn't grow with the loss. It grows dramatically faster than the loss. And at the far end of that curve is the reason this law exists. Compounding is a chain of multiplications. Your starting amount, multiplied by a return, multiplied by another return, year after year for decades. Multiply that chain by 0 just once, lose everything in a single bet, and no future return can ever bring it back. The entire chain collapses permanently. Every prior year of compounding becomes worthless, which is why the size of a bet matters more than the quality of a bet. Here's a number that surprises most people. An investment with an 85% chance of winning. When it wins, you gain 50%. Outstanding odds. Any serious investor would want those odds. Put your entire portfolio on it, win, and roll everything into the next one. Same 85% odds. Do that 10 times in a row. You survive only 20% of the time. An 85% winning bet, run repeatedly at full stake, wipes you out 4 times in 5. Not because the bet was bad. Because you sized it so that a single loss, which at 15% probability becomes a near certainty over enough attempts, ends the game. The 4th law, the goal is not to win big once. It is to never be forced out of the game. Size every position so that no single loss can bring your balance to 0. Because the recovery maths means the deep losses are the ones you never come back from. Protect the downside. The upside takes care of itself. And Law 5. The one most likely to start an argument at a dinner party. You've heard that the wealthy don't diversify. That they concentrate heavily in one thing, know it better than anyone, and ride it to enormous wealth. It's true. But there is always a condition attached to that advice and it's always left off. They concentrate in the one thing where they have genuine understanding and genuine control. Usually their own business. They aren't guessing. They have the inside view and their hands on the decisions. Remove the understanding and remove the control, and the same move that built their fortune becomes something else entirely. It's no longer conviction. It's speculation dressed up as strategy. Here's what that looks like in practice on the ASX. Pick one stock at random and hold it for the long run. The typical result, the median outcome, is a loss. 2 out of every 3 individual stocks end up worth less than they started. Only about 1 in 6 individual stocks beat simply owning the whole market through an index fund. So how does the overall market keep rising if most of the individual stocks inside it are falling? Because of a tiny number of extraordinary winners. Roughly 4% of all stocks produce the vast majority of every gain the entire market has ever generated. A small group of enormous winners drags the whole average upward and carries everyone who happened to be holding them. The ASX index doesn't outperform stock pickers by being clever. It outperforms them by guaranteeing it holds that 4% of winners, because it holds everything. And before you tell yourself you can simply identify the winners in advance, remember they are only obvious now looking backward. At the time, the future giants looked identical to the failures sitting beside them. Hindsight makes it feel pickable. It wasn't. If you can't reliably identify that 4% in advance, and the evidence says almost no one can, including professional fund managers, concentrating your money mathematically increases your chance of landing on a loser. Owning everything is the only guaranteed way to hold the few that make the whole thing work. The 5th law, diversification isn't weakness. It's a hedge against the limits of what any individual can know. And being honest about those limits is the most sophisticated financial move available to most Australians. Now here's how all 5 connect. The first 2 laws build momentum. Give money time. Feed it equity, not income. The 3rd law is about structure. Leverage can put that growth in your pocket or hand it to the bank. The direction of the lever is your choice. The 4th and 5th laws are about survival. Don't bet so big that a single loss ends you. Don't concentrate in something you don't genuinely understand and control. Momentum builds the wealth. Structure determines who captures it. Survival ensures you're still standing when it arrives. Miss any one of those 3 jobs and the other 2 can't save you. Before you invest another $1, run 5 questions. Can this compound? Is it built to grow over years, not days? Who controls it? You or someone else? What happens if it fails? Do you get something back, or nothing? Is the upside larger than the downside? And can a single loss remove you from the game entirely? And do you genuinely understand it? Can you explain in plain language how it makes money and what could go wrong? If you can't answer those clearly, you don't have an investment. You have a hope dressed up as a decision. The person who started investing early and stopped still won. Not because they were lucky, because the laws were working whether they paid attention or not. Now you know what the laws are. That changes everything. If this shifted something for you, hit the like button and subscribe. I'll see you in the next one.